The number of companies in the Compute 100 that he has touched is pretty vast, and maybe even more so than any other VC.
Today's guest is Shahin Farshchi. He is a GP at Lux Capital. Lux has over $7 billion in assets under management, and they remain to be one of the most premier deep tech funds of our era. I've been super impressed to get to know Shahin and hear his story from chip designer to investor in semis, and I know I love the conversation.
The Compute 100 is a podcast about the most consequential market in AI.
These are the conversations with builders and investors about the technology and the capital powering the greatest infrastructure build-out ever.
I'm Brian Schechter.
I'm Gaby Lorenzi.
We're investors at Primary.
Let's dive in to the Compute 100. This podcast is for informational purposes only and does not constitute investment advice or an offer to buy or sell any securities. Shahin Farshchi, partner at Lux. It's great to have you.
Great to be here. Thanks for having me.
One of the things that Gaby and I were talking about before, we're both really excited for this conversation because we feel like you've been focusing, your career started in the semiconductor industry.
Yep.
You've been at it for a long time.
Yeah.
It must feel kind of surreal to see the amount of interest that's emerged right now in this category right now. Like, I just would love to hear you sort of frame it of like how the evolution has taken place from your perspective in terms of it not being a category that was getting that much attention in tech broadly or venture to where it is today.
Absolutely.
And like, is it surreal or is it just you're like, I've known this was coming. It was just a matter of when?
So I would say more so the latter. Semiconductors, so long as I've been exposed to them, which is probably 30 plus years, have been cyclical throughout that entire length of time. So it's just a matter of time that they go in favor and then again out of favor. When I was a grad student, or even before graduate school, when I was an undergrad at Berkeley, companies would get started and built and funded based on the number of PhD chip designers they had on staff. And they would transact for some multiple on every head, that they had on staff. So I feel like semiconductors went out of favor in the mid 2000s and then came back into favor in the mid 2010s, and we could be at a local peak. There could be more momentum to go. I feel like this time is special just given the economic impact it carries with it this time around. First time around, at least during my adult time, it was very much driven by the internet infrastructure build out, which you could have said had large economic impact applied to it. But perhaps the economic impact this time around is even more significant, which is why there's even more dollars going into it this time around. But I've always viewed it as somewhat cyclical. And, it's not going to be like this forever. When times are good, when times are bad, I've learned that it's just a matter of time when it comes back into the spotlight.
How much do you think this is being pushed by like demand versus the technology? Both of those things work together in unison in some way.
They absolutely work together. If you go back to, say, the dawn of compute to, say, the turn of the century, semiconductors were very much, or innovations in semiconductors were very much driven by trying to move Moore's law forward. If you looked at compute during those times, compute was very much like food pre-agricultural era. People were just trying to be fed before agriculture. And in the earlier part of the compute history, in the 60s, 70s, 80s, 90s, it was just a matter of, okay, how do we build the compute that we need to solve basic needs as it relates to mainframe computing, personal computing, and Moore's law, which was shepherding capability forward, was pretty much mostly satisfying those needs, and the needs for operating systems, cloud compute, databases, finance. Like, it was pretty much being satisfied by the pure notion of shrinking the transistor. And workloads were very much built on the available compute at the given time. Now, if you fast forward to the mid 2010s, there was this new phenomenon called machine learning. And people realized that you can't just simply scale CPUs and be able to satisfy the compute demand that comes from machine learning. So the paradigm evolved from, hey, let's just shrink transistors and build more general purpose processors, multi-thread, do multi-cores, make those cores faster, add memory to them, to let's come up with a fundamentally new compute substrate that will solve this new problem. And so what we're seeing now is the workloads defining the compute, which initially GPUs were very amenable to or very conducive to because of their extremely flexible architectures. And now we're seeing companies like MADX and Etched come about that are trying to build compute that is very much tailored to these dominant workloads around large language models, and then other types of compute being built, like, for example, unconventional, that are being built in anticipation of the future compute workload. So one can say that the tail was wagging the dog up until the mid 2010s, because it was the very basic general purpose compute that was driving all of the applications. And then in the mid 2010s, the application space said, wait a minute, no, we call the shots. We're going to tell the compute community what kind of compute substrates we need. And that has been driving the compute designs. And that is the future moving forward, at least for the foreseeable future.
And so then that must inform your thesis around the AI's impact on EDA.
So EDA is a subset of this. EDA is traditionally a very misconceived space. So someone looks at EDA as they would typically UI. They say, okay, EDA is electronic design automation, is a method that I could just put boxes together, and those boxes represent some abstraction of a transistor or some other type of circuit element, and I can run a simulation and verify my design. Electronic design automation is far more, I would say, complex than the mere notion of assisting a design. Given the various parts of the semiconductor value chain, you have the design houses, you have the foundries, you have the OSATs, the people that do the testing and the packaging, and there's a lot of very, very sensitive IP involved. So the EDA tool providers serve more than just an environment to help people design chips. They broker the intellectual property, which is a very large portion of most products that are built today that get incorporated into the designs. They broker the relationship with the foundries with whom the actual chips are fabricated, and they handle all the sensitive technology that not only the IP providers, but also the foundries provide in order for someone to be able to design something that is compatible with those technologies. So there's a very, very complex set of relationships that come together within an EDA tool environment, which is why you see Siemens and Cadence have such a dominant position in the market, and it's been almost or virtually impossible for anybody else to come in, because all of those relationships and those many, many decades of trust need to be replicated. Now, we have seen, I'm sure you've spoken to several companies that are attempting to displace the EDA tool companies. And myself as a venture capitalist, it's naive to say never, because we've seen many small companies come and take the place of the incumbents. I personally have decided to stay away from companies that have been attempting to challenge the EDA tool environment. I have been more comfortable investing in companies that are working with the established EDA tool vendors and plan to coexist amongst them. Keep in mind that electronic design automation only accounts for a fraction of the effort that goes into designing a new semiconductor product. There's armies of engineers that do the front end design, everything from coming up with a chip architecture to actually laying out that design, all the way to the back end, which is verifying that that design that you generate in an EDA tool environment actually does what you hope it or what it's supposed to do. And so I feel like there is plenty of low-hanging fruit outside of EDA tools, which I refer to as physical design, which can be automated, which is what Cognitive is doing for specifically VLSI design, and others are doing in analog and mixed signal, which I think can be very interesting and can account for many, many billions of dollars in value.
And that's with them then plugging into the Cadence or Synopsys or Siemens.
That's right. That's right.
And was Cognichip a incubation for you guys?
No, Cognichip was a idea that founder Faraj Alaei presented to us, and we had the fortune of receiving that idea before there was a company, and we would call ourselves more co-founding investors, more so than having the privilege of incubating.
Maybe I'd love to just like go a step back in terms of your journey pre-Lux, and then what made you decide to become a VC, and kind of how the two major stages of your career supported each other.
Sure. So I grew up here in the Bay Area, always had a passion for cars and computers and science. I wanted to become an automotive engineer, but just watching my friends become worth millions of dollars on paper by doing entry-level jobs at random.com era startups, I was subject to greed and went to Berkeley and did electrical engineering and computer science. I very quickly realized that I'm not a developer. I had friends that would sit down and code for many hours in the basements of Soda Hall. And I felt like I was more interested in device physics and circuits, more of the double E side of ECS. So I did that and graduated, unfortunately, in the dot-com bust. And it was so depressing when I would go out and interview in Santa Clara, Sunnyvale area where parking lots were empty and offices were half empty. I decided to go to Detroit in pursuit of greener pastures and try my hand at automotive engineering. And what I realized very quickly was that I did not want to be part of a large company. You would go into these meetings, there were 20 people in the meeting, you barely had a chance to say anything, and it was ultimately just checking boxes and covering other people's backs, or protecting other people from liability effectively, which is what it felt like it came down to. And so I decided to come back to California, did a PhD in electrical engineering at UCLA. And that was during the tail end of the CMOS RF revolution, where CMOS being a technology that allowed basically very, very cheap digital chips, very low power, inexpensive digital chips. So you can put a microprocessor in a microwave or in a toaster, being extended to analog and mixed signal. So if you recall back in the 90s, a cell phone was the size of a brick. It cost many thousands of dollars. Very few people had them. And by virtue of being able to adapt analog and RF into CMOS, you are now able to make a chip that used to cost hundreds of dollars now costs pennies. And so I started graduate school in the tail end of that, and I was very captured by the notion of extending CMOS technology, adding ones and zeros together to these other dimensions. So it was initially, for example, mixed signal and RF, and then there was power, and then there was photonics. In fact, there was a Science Friday episode that I was listening to as a grad student that was interviewing Alex, I'm blanking on his last name, but he was one of the founders of Luxtera. And he was talking about how they were using conventional CMOS technology to make photonics. And I thought that was absolutely mind-blowing. Now, photonic integrated circuits are pretty commonplace today, fast forward, 25 years later. But back then, it was an extremely exotic notion for me. So this whole idea of using traditional CMOS, traditional silicon to do these more exotic tasks and basically commoditize everything from photonics to power electronics to sensors and transducers. For example, the accelerometers that we have in our phones. These were all very novel concepts back in those days. That is what intrigued me to do semiconductors. And then you may ask, well, why do venture? My whole foray into venture was very much an accident. So I started a company around my research. I learned very quickly that it's one thing to have an interesting business, another to have a real, technology. I had a technology, no business.
And what was the technology?
So my PhD research was on designing very low noise amplifiers to capture brain signals. The basic physics says that if you want to make an amplifier low noise, then you pump in more current. Imagine, having a faucet that's dripping water, trying to encode a signal in that, versus a fire hydrant that's going out. Well, obviously with the fire hydrant, it's much easier to encode a signal in that than like a faucet that's leaking water. And my thesis was, well, actually, when you have a faucet that's leaking water, there are interesting ways you can put to work to be able to actually get a very high signal to noise in a very low power environment. So that was the thesis that I proved out using a very, very ancient silicon technology, as a 1.5 micron CMOS technology. But anyway, I dumbed that down and built a company around that to do wireless biosignal monitoring. So instead of doing brain recording, monitoring vital signs, and being able to wirelessly monitor patients in hospitals. And hospitals are very eager to have that kind of capability, to be able to monitor patients, especially while they're being moved around. And I learned the hard way that it's one thing for a customer to want something, especially in healthcare, and it's another for them to actually pay for it, find the budget to pay for it. And this is smartphone. I had to build these computers from scratch that had wireless capability, and they cost me like $1,000 each to build, and they didn't want to pay more than like $100 for them. So that was a very, very important lesson in business. And I didn't raise any money for it. It was completely bootstrapped. And so I wound that down, and I got a great piece of advice, which was, hey, like, you should raise money from venture capitalists next time around. Like, what's venture capital? And
what year is this?
This is in 2005.
Okay.
And I said, I don't know any venture capitalists. I thought of my perception of venture capitalists back then were, rich white guys, playing golf. And if you happen to have, the right relationship or go to the right country club, then you'd be able to meet these people and maybe have them fund your company, convince them to fund your company. And I was, I basically sat down and I Googled a bunch of VC firms, and I blind emailed them offering my help in diligencing and scouting for semiconductor companies. Because back then, semiconductors it was in the tail end of that cycle. And I Googled nanotechnology and venture capital. Lux Capital was the first search result. Never heard of Lux, didn't know VCs exist in New York. And so I sent them the same note. Hey, I'm in California. I can help you, scout for deals. I can help you due diligence. If you guys, are interested in semiconductors. They emailed me back the first day, said, hey, we're raising our first institutional fund, come to New York. And so I would basically submit papers to conferences in New York. I was postdocing at that time to pay my bills. And when I get admitted to speak at those conferences and present my papers or do posters, I would basically fly out on the university's dime and then hang out with the Lux guys. I'd present my paper and then go hang out with the Lux guys. And a year and a half later, when they closed that fund, they asked me to join full time. And I wasn't expecting a job offer, but I was just so impressed by their ambition, by their raw intellectual horsepower, and thought they're going places, so I might as well hitch my wagon to that rocket ship.
Wow.
And here I am 20 years later.
Wow, 20 years later. And the Lux V1 pitch was very true to the pitch today, is my understanding in terms of.
The initial vision was that the next wave in great innovations and great companies post dot-com bust will be rooted in the basic sciences, or nanotech, which was a buzzword back in those days. And we, with nanotech kind of fading, we stayed, we stayed true to our roots of being an emerging technology focused firm. And with every investment that we make, we ask ourselves the question, what can this company do that nobody else can do? How is that going to have a giant impact? How is this company going to create a giant market? How is that giant market going to be the basis for this to become a monopolistic, multi-billion-dollar company? And so that's continued to be our mantra. You can call it deep tech, you can call it frontier tech. These are all terms that have been coined since.
Mm-hmm. And so how are you thinking about that right now in terms of what's happening with AI and the semiconductor industry, the models, how the models will play out?
Absolutely. So we touched on this earlier. The models are constantly evolving, and the challenge that we've observed is that semiconductors just can't keep up. If you look at the half-life of these models, they can be on the order of months. And if you look at the half-life of a chip, it can take years. And that led us to exploring several themes, one of them being applying AI to chip design to collapse the amount of time and the exorbitant expense that's associated with designing these chips. And so you can design a model and then concurrently to that, design the infrastructure that you need to be able to train those models and serve those models. That might sound crazy, in 2026, but fast forward to 2032, perhaps even, it may become commonplace. And so in general, as you've seen, semiconductors have become, now energy have become the bottleneck, and training and serving larger and larger models. And this challenge itself has even made me more eager and excited to explore and make investments and build companies in this space.
I'm curious as someone who obviously has been in this market, and like we talked about earlier, you guys were early to this party that the world is now at. What were kind of like the obvious signs that this was coming, maybe even like 10 years ago, 5 years ago, when you think about businesses you were looking at, the way the technology was changing, that we were moving away from this like very general purpose compute world into one that was, the dog wagging the tail instead of the other way around?
Sure. So this thought process dated back to probably 2013 when I sat down with Naveen Rao. So I've known Naveen since grad school. So when we sat down in 2013, he said, "Hey, I started this company, Nirvana, coming out of Qualcomm. I had this idea while I was at Qualcomm that convolutional neural nets are going to become a big driver for future compute workloads, and simply designing FPGAs to run those workloads, which was the kind of the thinking at the time, is not a scalable idea. And I want to build dedicated compute to be able to run these convolutional neural nets optimally." Now that seems obvious right now, but back then, convolutional neural nets were being used for image recognition, for object tracking, basic perception, predominantly in the lab, for use cases like driverless cars, for geospatial imaging, for robotics. And so it was very much a niche product meant for a niche industry. But for me, it just felt at the time, it felt obvious that it's just a matter of time that these types of workloads are going to be commonplace. Because at the time, most of the dialogue was around the cloud. It was around virtualization. That was where the money was. And I'm not saying that, I was particularly smart. I'm just saying that I was interested in something that there wasn't a lot of dollars and attention being put on. Because if you think about it, there was many, many, many billions of dollars being spent on transitioning to the cloud and all of the efforts around supporting that. And GPUs were doing the job for that. Not GPUs, sorry, CPUs, general purpose processors were doing that. So if you were involved in compute back in those days, you were inundated with demand that was being served by the dominant compute paradigm of the time. So you weren't, what we're talking about in terms of like convolutional neural nets is sort of like the backwater of compute at the time. And as you can see, over time, that came to dominate.
I mean, part of that is now like Jensen himself has like the narrative of like, we were there for AlexNet and we knew that intelligence was coming and a new compute paradigm was coming and the GPU was the perfect thing for it. And that's proved out to be incredibly true for NVIDIA and how much they like saw it at that moment versus how much it's just now the narrative of the company's sort of path to glory is not totally, doesn't really matter. But it sounds like part of what you're saying is that the GPU did a good job taking on the sort of AI-centric workloads.
Sure.
But
Yes.
that we're now entering a paradigm where specialization or perhaps other modalities for chip design and chip creation will be needed for ever-evolving algorithms that have more and more scale associated with them. That's creating all this like a new playing field for chips.
That's right. That's right. And I feel like Jensen's done a masterful job taking what he had in the mid 2010s, which was this, graphics accelerator, and building all the software on top of it to make it a extremely attractive substrate for this new compute workload. Like, he was at the right place at the right time with a extremely desirable product. So good on him for doing that. And he's been able to sustain that for the good part of a decade. And it wasn't until very recently with the Grok acquisition that he's now going towards that path that you just described, which is basically co-design, where you're building the compute to match the workload, which was accelerated through the Grok acquisition.
And so earlier you talked about the sort of the algorithms changing all the time, which is certainly, like, I guess my view on that is that it keeps on changing, but it's still so matrix multiplication dependent.
Yeah.
And so there's more orchestrating going on as we move into a world of agents, as we move into a world of a mixture of experts models. Like, there is more complexity, but there's still this core
That's right.
matrix multiplication task to be done in the paradigm we're in.
That's right.
Now, maybe we move into a new one, like what Jan LeCun kind of world of like world models, and something entirely different than this sort of next token prediction process. How do you think about what's coming about, like, sort of how much are we in a transformer-ish world for a while versus like we're 6 months away from?
Yeah. So I don't want to comment on the algorithms because I'm not an expert there. And I agree with you that the basic nature of compute will still be along the same lines. All I've observed in the past 4 or 5 years is that there are some constraints that are becoming more and more apparent. One constraint, for example, being memory. So people always knew that these large language models, transformers, and whatever's going to come after them are going to be extremely memory and memory bandwidth hungry. And you saw companies like Cerebras, like Grok, build these reticle scale chips that have a lot of SRAM. What we've been realizing, which led to our investment in Majestic, has been that there needs to be more than just packing SRAM onto giant chips to be able to continue this trend, to the point that you were making earlier. And that led to taking a system level solution, a system level approach to building a hierarchical memory architecture that can leverage cheap commodity RAM, DRAM, DDR5, to alleviate some of the requirements for HBM and on-chip SRAM to continue on this path. So we're not talking about an algorithm-specific solution. We're talking about a general solution that is anticipating a trend of more and more memory intensity.
Can you talk about Majestic for a minute?
Yeah. So this is a team that I'd known for many years. I've been tracking them from their days at Google when they were running the inference chip efforts there. And then they were recruited into Meta, and they built the chips for their products. And I was aware of this. In fact, Naveen and I had talked about this memory wall problem. And when they didn't approach me, I chased them. I asked a friend of mine who's actively investing in Israel, hey, who's the smartest entrepreneur that you know out there? And he said, oh, you have to meet Ofer. And so when I met him and he told me that he's working with Shah and Masumi, I was extremely excited to hear that. And when I asked, what he's doing, and he told me, oh, hey, we're going to solve this memory bandwidth problem with not just a new chip, but it's with several chips and a whole system architecture. I was immediately intrigued and was very swift to offer to lead their seed round. So that's the story there. But their approach is around building the chips that you need and the interconnect that you need, using as much that's available off the shelf to build a system level solution.
And so Ofer and a lot of the founders you've backed come from like deep silicon backgrounds, whether it be Faraj at Cognichip or, you know, the team at Majestic or Naveen with Unconventional. Obviously, you've got your own bias probably as a previous PhD, but talk about the backgrounds of the people that you've backed, but then also this like emerging new generation of young people who all of a sudden.
Absolutely. So semiconductors traditionally has not been a young person's game.
It is not.
It's one that requires deep relationships, which take many years to cultivate. It requires a lot of experience, actually having taped out chips, watching things get delayed. I like to give this example of building a house. Like when you're designing a chip, it's not like, you know, a bunch of hackers sitting in a room, you know, eating pizza, you know, writing code. Like you have to coordinate with a bunch of companies that may not even want to return your calls. And so when you design a modern chip, there's a good amount of IP that you have to buy or license from others. And many of them have no reason to even return your phone calls because they have big customers, i.e. NVIDIA, Broadcom, you know, they're not going to deal with a startup. So a lot of these chip entrepreneurs were previously at these big companies where they were the customers of these IP houses, not only the IP houses, but also the people that also help engineer your chip. So it's kind of like building a house. So if we're building a house, we're not actually out there, you know, hammering, you know, wood. We're hiring framers, you know, plumbers, drywall people, electricians, pool people, roofers, waterproofing specialists. There's a bunch of people that have to come in and be part of that process. And the same goes with semiconductor companies, people that do front end, back end, the IP, the actual fab, the back end testing, the packaging. In many cases, you need an interposer. In many cases, you need some kind of co-packaged copper or co-packaged optics in the future. So like you need relationships with those vendors because otherwise those vendors are only chasing the big dogs. And so that's where the age typically comes in. Faraj picks up the phone, the right person at Intel answers. In the case of RFA, Shervin picks up the phone, the right person at Skyworks, for example, answers. So there's a need for that, but that's changing. So yes, historically, during the course of my career, I've backed people like Naveen, who ship multiple products, you know, Qualcomm, Sun Microsystems. Faraj started multiple companies, took them public, was an executive at Marvell. For example, you know, Luxtera, Greg Young, you know, was a former Intel executive. Broadcom executive. So yes, but in fact, there's an investment that we are in the process of making right now that hasn't been announced, which if you would have asked me 10 years ago, would I ever fund a 20-some-year-old to do semiconductor packaging and test, I would say absolutely not. Who would give a 25-year-old their chip that cost $1 billion to develop, that took many years to actually do the packaging and the testing for? Absolutely not. But I'm doing this because I have incredible faith in the founder. He's done a phenomenal job building trust and building confidence with the grizzled old people that would be his customers. And he's built a remarkable team around him. So I would say that this time it's different. And these younger teams are absolutely backable, and I'd love to meet them.
Let's talk a little bit more about that in terms of the key traits you're seeing among these younger founders. You know, we spend a lot of time on college campuses and they are trying to understand which skills, you know, technical skills they need to learn, but also, like you said, so much of this industry is like relationship building. How do you, you know, test a 20-year-old on their ability to be able to call up an Intel exec, or what are the signs you're seeing?
I was curious what that founder did to build.
So that founder, I'll give you the story, and maybe someday he'll elaborate. So this founder came into my office. He showed me an SCM of their product, and I saw the picture, and I said, "Oh, I know what this is." He wouldn't even tell me what it was. It was just in the SCM of some structure, and I knew what it was. And I knew there's 3 companies on the planet that would buy this. One of them happens to be in California, and I happen to know the founder of one of them. So I called the founder, who's no longer CEO. He put me in touch with the CEO, called the CEO, I said, hey, do you know this guy? And he said, yes, and their products are the best that we've ever seen, and we plan to buy these products. And then I called him and said, okay, can I invest? So it was that simple. So the fact that he was able to get something in front of an extremely conservative company,
Yeah.
and get to the get on the radar of leadership at that company that could be a multi-billion-dollar a year customer was something that was easily justification for making an investment.
And how did you meet the founder in the first place?
How did I meet the founder? Good question. I think it was either my partner who introduced us or a mutual friend. I feel bad not remembering, but I should know that.
Are you like the sort of deals flow to you at Lux in the semiconductor world?
No, at Lux we're jacks of all and masters of none. It just so happens that this particular area that this company was working on was very much up my alley. So whether it was my partner or if it was somebody outside of Lux who brought it, said, hey, like Shahin, you should take a look at this.
So we have this view that's very much informed by the Etched investment. And then it's sort of our kind of interest in it is growing as we collect more data points around young people going into electrical engineering, mechanical engineering instead of computer science, and this sort of movement that we see of young entrepreneurs and builders towards hardware in general, and then some of it into the compute world because of just how central it is for the AI revolution. And there's this question, seeing the way that Etched has had to navigate having a team of founders all who are college dropouts, mm-hmm. and how they've had to build a company that hires for trust and relationships and know-how is like absolutely essential. Mm-hmm. And there's something absolutely essential about the sort of fresh perspective and just raw drive of a 20-something-year-old.
That's right.
And we're really just interested in like how that's going to play out over the next decade where you get teams that can kind of have this marriage between industry expertise and connectivity with this. It's almost like I think it was like people who came of age during COVID and the sort of beginnings of AI having like kind of skipped a few levels of knowledge and life challenging ability to just go do anything.
That's right.
And then wanting to get them into the same room as much as possible.
Yeah.
I know that's just something we were thinking about a lot and wanting to find teams that feel like they have that ability to bridge those worlds.
That's right. And I feel like a lot of these disciplines that you mentioned, semiconductors, like everything outside of software, engineering outside of software, I feel was very incremental. And when we're talking about disciplines that are incremental, that's where experience, relationships, everything that requires an executive team that is older and more experienced and more connected. If you look today at how these industries are now rapidly changing, mm-hmm. and basically all bets are off, and there is this existential threat that, oh my God, like if I'm an engineering, procurement, and construction firm, I really need to take AI seriously. Otherwise, my competitor is going to bid the same project at half the price and deliver it in a quarter of the time. I need to adopt, these tools, this technology. They are now far more open to hearing a disruptive, solution or story from people that don't look like them, that are half their age. And if you are a member of that technical community, you are probably more interested in joining a team that resembles, the college dropout, kind of demographic of Etched, more so than the grizzled, demographic of some company that's been around for 30 years, knowing that that company that's been around for 30 years probably will be outcompeted by the more aggressive team underlying Etched or companies like Etched.
We actually just spent a lot of time doing some analysis on M&A and its role in the semiconductor industry. And it has obviously played a huge role in the sense of so much value drives towards these duopolies, whether it's, NVIDIA, AMD, or the Synopsys and Cadence. But now we're seeing a ton of acquisitions happen, maybe not now, but over the past as well, with a focus around teams that have really unique skill sets that can accelerate incumbents' pace of development. So, Grok is an example of having this unique talent around SRAM and the ability to actually incorporate that into NVIDIA's next product line. Wanting to bring that talent in-house was obviously part of that acquisition. How do you think about M&A in terms of, like, as a VC, obviously you're thinking about the path forward for your companies. There's the talent aspect of it. There's also the number of acquirers is growing. Now, like, OpenAI could buy a chip startup, or Anthropic could buy a chip startup. Right. I'm curious from the talent angle, and then also from just the ability for these incumbents to need to keep up and compete, like you said.
That's right.
M&A just plays such a pertinent role here. I'm curious.
It does. So at Lux, just to give you some background, we're currently investing out of a $1.5 billion fund. Mm-hmm. And so we are ultimately solving for building lasting businesses, selling into giant markets with monopolistic positioning, meaning that with every investment that we make, we expect them to become a double-digit billion-dollar outcome. Now, to your point, sure, the Grok acquisition or license, whatever you want to call it, was a double-digit billion-dollar outcome for NVIDIA. But it's very difficult for us to solve for that. I mean, Grok had been around for almost 10 years, if I recall correctly. And I don't think anybody, I would be shocked if anybody that was writing one of those early checks into Grok anticipated NVIDIA, because NVIDIA at that point hadn't paid billions of dollars for anything, paying $20 billion for that. And in fact, in my career as an investor, I sit down and write these memos, and I write a laundry list of potential acquirers. Not one of the acquisitions that I was involved with was done by a company that I had anticipated when I had written these memos in our early investments. So it's very challenging to invest with the intent of acquisition. You invest with the anticipation of a company becoming a lasting, independent, durable business. And we don't think about liquidity. We're a very long-term fund. We have a 10 plus year investment horizon, so liquidity can occur as an IPO. It could be some form of secondary transactions or an M&A event. And what you're describing is absolutely a good thing. That there are richer and richer companies that have a greater demand for these expertise that are being cultivated in these companies. But our hope and expectation is that these become standalone companies. But again, like the widening M&A market is absolutely a good thing.
How do you think about this? This is more of a very general sort of VC question, but how do you think about what's coming in terms of liquidity and this tendency for companies to get bigger and bigger and a smaller and smaller number of companies really mattering? Mm-hmm. Where, as you said double-digit billions.
Sure.
5 years ago, unicorn was like hallelujah. Now it's like that's just not going to cut it.
That's just Tuesday.
And so
another company became a unicorn in the portfolio. Okay, well, big deal. You don't even get a patent back on that anymore.
So how do you think about this, of like what in the world is coming? It feels like we're in uncharted territory, or do you feel like, well, we're in a cycle and there'll be another sort of wave of sort of IPOs that kind of bring us back to a historical norm?
What you're describing is a reality that the power law has compressed. Yeah. When I started doing venture 20 years ago, it was a matter of buying low, selling high, finding a founder early, getting in at a good valuation, and hopefully exiting that investment for 10x your original investment. That math no longer applies. Now, it's a matter of getting into the generational companies. So it's a matter of getting into the companies that matter. in every cycle or every year, however long, whatever duration you want to keep in mind, there's going to be a handful of companies that matter. And as an institution like ours, we need to be in those companies. So the question we ask ourselves when we make investments, of course, is what's the valuation? What's the market size? We ask all these questions. But the most important question is, if you fast forward 7-8 years from now, is this going to be one of the, say, 30 or so companies that matter? If you look today, there's Anduril, Applied Intuition, SpaceX, Ramp. Like, these are the companies that matter. Is this company going to be in that class? That's the question we ask ourselves. And if that's the game that you're playing, then valuation becomes less relevant, which is why you're seeing these valuations get inflated the way they are right now.
And I think and fund strategy starts to change too, not just around valuation, but around like at what point do you enter? Because
That's right.
if all of a sudden it feels like, well, there's a relatively finite universe that I must get into, you could miss the boat 1, 2, 3, 4 times and say, like, I'm still going to get in because it ramp at 20 billion. If I believe it's a generational company, it's going to end up at 120 billion or whatever.
Exactly.
It's like the cost of not participating. I think there's like a Larry Page quote around like the cost of not participating in AI is, when they're trying to justify CapEx, is basically like the cost of not participating is far worse than the cost of participating.
Exactly.
And so I think it's interesting. You also think about like there's some metric around basically the ceiling of company valuations just continues to step up, and so it's just the universe is just becoming more valuable in terms of total value in market and private markets.
Exactly.
And so it's interesting. I'm curious around that framework that you guys have of like, what are the things that you think about internally to justify how, a new semis company will become one of these top 30 companies?
Right.
What are the things, obviously there's the obvious like TAM and, there's
Sure.
growth story, product roadmap, but how do you guys justify that when you think
Sure.
about that framing?
There's two questions there. So one question is, how do you justify the aggregate value ballooning?
Yeah.
So there's fewer companies, and these fewer companies are worth orders of magnitude more. And so the hypothesis needs to be that this market capitalization is going to be justified by future market creation. So you need to believe that. If you don't believe that there's going to be a market created as the result of the success of these companies, then you can't justify, 3 companies being worth $1 trillion each versus 20 companies being worth $5 billion each, for example. I'm exaggerating here, but you get the idea. So to answer your question, what do we need to believe? We need to believe that there's going to be a disproportionate amount of aggregate value creation. And we've seen this happen over the course of history, and we've seen it not happen, over the course of history. And as a result, there's value destruction as a result of that. But as a whole, if you look at the whole telecom cycle, if you look at the internet bubble, ultimately economies have benefited, and some companies have emerged. In fact, there was a tweet that I put out yesterday. There was this Wall Street Journal article saying that, OpenAI's revenue is going to double, but their burn is going up, significantly. And I pulled out, a disclosure from Amazon that showed their revenue go up significantly and their burn go up even more significantly. And yes, their share price, changed over time. But if you'd held that stock, you would have been handsomely rewarded for your patience. So yes, a lot of companies don't do well, but yes, the good companies do extremely well. To go back to semiconductors has gone from, when I first started doing investing, from delivering a point solution to delivering a broad solution. So back in 2008, 2009, when I started doing chip investing, chips needed to perform at some level to be able to command some kind of market presence. Oh, your power needs to be below this. Your performance needs to be in this envelope. You need to be able to be fabbed on this, at this foundry, and you need to cost less than 50 cents, whatever. Like if you met those parameters, then there was a market available to you, and you could achieve a market cap of a couple $2 billion, maybe. Like that was the math for a chip investor. Now the math has changed entirely. You need to build an entire system. Look at Cerebras, like they're offering a cloud solution. You need to build a system. You need to build an entire software stack on top of it. If you're a developer and you have the option of using the software stack that's available from NVIDIA, why would you not do that and go on some unproven software stack on an unproven hardware substrate and risk losing your job? Back in the day, there was that phrase, you don't lose your job by buying from IBM. Same thing today. If you're an ML engineer, you don't lose your job by using NVIDIA. And so the challenge, I think, is far greater these days. And there's a large number of disciplines that come into play for these companies to be successful, which also goes to the question that you guys asked about younger entrepreneurs. Those younger entrepreneurs can also think more broadly than that grizzled executive that can do one thing, because the demands have also changed over time, and they need to build all these different multidisciplinary teams to be able to compete in a way that they didn't have to back in the day.
I want to hear what's keeping you motivated to do this job.
Meeting amazing people. I mean, like, I had the privilege, and right after this, I'm going to meet another great founder, also young, but just being able to be in the flow of all these great ideas and just feel the passion, feel the ambition to do something transformational. I feel like work the way we know it, products the way we know them, our day-to-day lives are headed for a huge change, just like they changed dramatically from, post-industrial, like we were all in the fields, a couple hundred years ago, and then we went to the factories, and then we went behind desks. And I feel like there's another massive change that's coming. Maybe we'll be sitting on our couches, but I feel like it's a huge shift that's coming, and there's great technologies and great teams, great companies that are going to drive it. And I feel extremely privileged to be part of that transition and to be helpful to these great entrepreneurs in some way.
Do you think you'll be doing this job in 20 years?
There's nothing else I know how to do. So hopefully, yes.
Chip design has changed too much to be able to go back to it.
It's going to look different. So I have a couple of other quick questions.
Well, my job is automated. Hopefully, if these companies are successful, then my job is now what I was trained to do in grad school is now going to be completely automated.
Yep. Or you could become a data labeler for the.
That's right. I'll be a data labeler. Oh, this is an op amp. This is a mixture. This is an oscillator. Yeah, exactly.
Or you could do it for VC deals.
There you go.
I was listening to a Jensen interview where he's talking about the idea that the AI industry has things completely wrong about job annihilation through AI. I'm just like, no, this is totally crazy. It's going to create jobs. There might be certain areas of job elimination, but more often than not with white collar jobs, it's going to actually create more jobs because it will increase productivity. And I've sort of gotten interested of just how stark the contrast is between what, say, Dario is saying about like what is coming and what Jensen is saying about what is coming.
Yeah.
What do you think about that?
I am absolutely baffled by the uproar around we're destroying jobs, because the facts are out there. Yeah. Economies that have more automation have less unemployment. There's facts. You can look it up. And I still get baffled when I hear people saying, these robots are out to get our jobs, AI is out to get our jobs. And the reality is that that's not the case. These economies that employ automation, that use technology, have less unemployment. And the people who are employed get paid better and have better quality of life. And so my expectation here is that, yes, there will be job destruction, no doubt. There will be jobs that probably you and I wouldn't want to do in the first place that are going to be destroyed. And the expectation is that the people who were unfortunately doing those jobs back then will be reskilled and trained to do better, higher paying jobs, of which there will be more of. That's the expectation. And so that's non-trivial. So I don't want to completely dismiss what Dario is saying. Like he's right that we need to educate people.
Yeah, but he's also saying that there's like this 30% sort of like job elimination tsunami coming. That it is in stark contrast to that data, and also to what we're seeing right now with what's happening with software engineering roles. where software engineering roles were going down for several years.
Yeah.
And are now over the past like 6
Yeah.
months are sort of skyrocketing precisely the moment when automation and sort of software engineering is also rising.
I'm hearing about people simply, developing code just by whispering into their headsets, which is mind-blowing to me in a good way, but is also very scary in that like these jobs can be completely eliminated.
We had someone on our team this morning who said that she was like, "Oh, I just decided to code my own Calendly because I just thought it would be easier for some use cases we have."
That's right.
There's things like this that are going to be, whether that's a job or a feature. It's fascinating to see what you can build. And she's totally non-technical, it's just coming to this from a perspective of give someone tools and they can build themselves the world, which.
And that's like a SaaS-pocalypse question.
Totally.
And that's why we've seen the carnage in the markets for all these software companies, because now they've become completely superfluous. However, I feel like there was some overreaction there because there are many software companies that do more than just provide an interface. I think the misconception is that software is only an interface. Is only a connector to a database, and it's much more than that. There are some companies that are no more than an interface, and yes, you can vibe code that. You can vibe code the simple UI, but there's so much more that goes into it that you can't just vibe code that many of these great software companies are capitalizing on that will continue to be a big value driver for them. So I wouldn't just dismiss them the way they were dismissed earlier, but that was just a one-time event. So I am a huge advocate of educating our workforce, and it's my expectation that with the new solutions that will be brought to bear by these frontier labs and the companies that use their technologies, more and more problems will be created, and we need the workforce to solve those problems. And so, I feel like instead of panicking, people should be trying to solve that problem of anticipating these new roles. What are these new roles going to be? And then using AI to train people for those new roles. And it's my expectation that if history were to repeat itself, that many roles will be generated and many people will be needed.
Amazing.
Awesome. So good talking. Before you go, what size checks are you guys writing?
We write checks from $100,000 to $100 million.